Hello there, welcome to Commodities, and another dramatic day in energy markets with the US crude price going above $80. Look at that, a jump of almost 10%, and we're at nearly $82 on North America's crude benchmark. You can see gasoline up, as you might expect, in tandem with that, and natural gas, even though the domestic natural gas market is largely isolated, at least in the near term, from the global picture. Okay, so let's have a closer look at oil. We're going to have lots about crude today. India's state-run Hindustan Petroleum, according to Reuters, has started buying Russian crude again after a gap of about 3 months. That's according to sources who talked to Reuters. India had been importing a lot of Russian crude. It slumped in January to the lowest since 2022 because New Delhi wanted to avoid U.S. tariffs. However, they apparently are buying it again. More tankers under attack in the Gulf, Persian Gulf today, with the U.S.-Israeli-Iran war escalating. Iranian drones apparently entering Azerbaijan in Central Asia, or in the Caucasus region, which is itself an oil producer, and that threatens to spread the crisis wider in the oil industry. Let's have a look now, and you can see there Canadian energy stocks trading near record highs. Let's have a look now at the metal market. Interesting story out of Bloomberg that Poland's central bank chief has proposed selling as much as $13 billion US from gold reserves to finance defense spending. And apparently the nation's president interested in that. If other central banks get the same idea, of course, it could cap the incredible rise we've seen in gold over the past 2 years. And Bloomberg also says there's a bearish mood in the physical copper market due to weak demand in China, and also traders winding down deals to move copper into the U.S. market ahead of possible tariffs. There's a huge copper accumulation now in the U.S. Apparently, copper sellers are struggling to offload cargoes. One observer who spoke to Bloomberg said, as much as copper is critically important, a critically important industry, and there's lots of underinvestment in new supply, we are in thin air right now, and this could set copper up for a bear market. Let's have a look at aluminum. Citigroup says aluminum could well go much higher due to the conflict in the Middle East because it's, well, aluminum down though, although you can see it's had a big run over the past year. Citi says, we think the market will hit 3,600 a ton within 3 months, possibly 4,000. Smelters in the Gulf account for about 9% of global production, and they've been unable to move metal or bring in raw materials due to the virtual halt of shipping through the Strait of Hormuz. A few other resource stories we're bringing you today. Shares in Tourmaline Oil, the big Canadian gas producer, did come under some pressure. The company posted record production in its latest quarter, but profit and revenue missed estimates. Tourmaline said it sold natural gas assets in northwestern Alberta for $765 million. It didn't disclose the buyer, but said it's a senior Canadian producer. Canadian Natural shares hit a record high. This is the country's biggest oil and gas producer, posted revenue that topped estimates as well as better than expected profit. It was record production, and that helped to offset weaker oil prices. In fact, output was up nearly 13%, and the company boosted its 2026 production forecast. And Bloomberg is reporting that China has told top oil refiners to suspend exports of diesel and gasoline due to the escalating conflict in the Middle East. Beijing is apparently calling for the temporary suspension to begin immediately, with some exceptions. There has been a scramble across the globe, particularly in Asia, though, to prioritize countries' needs because there's a crisis deepening with refiners from Japan to Indonesia and India cutting back run rates. Well, let's get more on this rapid rise in oil. Crude, as I mentioned, pushing above $80 US in North America for the first time in more than a year. Bloomberg's Will Kobzanski joins us now. Thank you very much, Will, for coming on. It was interesting. If we look at a one-week chart for oil, originally the reaction was relatively muted. Sure, oil went up, but it sure has accelerated over the past couple of days amid fears that this disruption could be prolonged.
Yeah, it's interesting. In the early days of this, I think there was some hesitance among traders who had sort of seen this movie play out, or at least they thought they had a couple of times, both in 2025 in Iran and sort of before in 24. And as you can sort of see today, the reaction is gradually shifting to one that would suggest this could last for longer than a couple of days. The U.S. could be in Iran for as long as September, Politico reported earlier. So yeah, traders beginning to price in what an extended disruption to flows through the Strait of Hormuz might look like.
And this is such a massive global industry. 100 million barrels of oil we burn as a species every day around the globe. And refiners in many of the major industrial and processing regions already shutting down.
Yeah, it is a pretty existential moment for refiners, especially in Asia. I mean, look, the crisis is going to extend effectively anywhere that you're going to refine oil. In Asia, it's particularly bad because you need that crude coming through the Strait of Hormuz. But yeah, look, as Asia needs more crude, right, they're going to pay more for it. You're going to see interesting displacements like India buying Russian crude again. And broadly speaking, price of crude is going to go up, and the price of refined products is also going to go up because just the market is getting tighter by the minute here.
And we talk a lot about the crude price, but the shortage could well develop even more rapidly in diesel and jet fuel, the products made from crude oil.
Yeah, diesel and jet fuel in particular are exposed to this. They run a pretty significant amount of product that's refined in the Gulf through the Strait out into Asia. And we're already seeing massive price hikes on jet fuel in both Asia and Europe and here in North America as well. So yeah, the price impact is going to show up faster on the product side because not only are you having a limitation on how much product gets exported, you're also missing that crude that you use to make the product. So a lot of things converging at once here in what is a pretty wild scenario for the global oil markets.
It really feels, it's funny, isn't it? You may have touched on this, but I think you did, past exchanges of missiles and attacks on Iran haven't done that much to the oil price, but this time it feels different, perhaps temporarily. Maybe we could put up a 5-year chart.
Yeah, it's been quick up and then quick down, right? So the 12-day war in June 2025, prices spiked really quickly. The U.S. then made pretty clear that they were getting out of the region as quickly as they could. And so I think traders were wary, right, that well, this might just be another couple of days in, we, return to the negotiating table and the U.S. signs a favorable deal. That could still obviously happen, but clearly traders feel like the odds there are much lower than they did initially when this war began.
Will, thank you very much indeed for joining us.
Thanks for having me.
That's Will Kobzanski of Bloomberg. Up next, we're going to focus a bit more on the strategic implications of this, in particular Europe's volatility, because it has pretty thin margins of crucial fuels such as diesel and jet fuel. And China may emerge as a relative winner here because they snapped up vast amounts of oil at low prices. That's ahead. Let's get more on the global implications of this massive run-up in oil prices, with North American crude topping $80 US today. We're joined by Michelle Brohard, Head of Policy and Geopolitical Risk at Kepler. Michelle, thanks very much for coming on the show. You guys have got an outline list here of potential winners or countries that are relatively invulnerable to countries that are vulnerable. Start off with Russia. Of course, this could well increase demand for that nation's crude.
It could, and Russia is still sanctioned. Certainly, their price has been under a lot of pressure as the global supply was was abundant before the war. Now that the global supply is constrained, Russia can emerge as being able to sell their oil relatively close to market prices. So they really do emerge as a winner in this.
They have been looking at big discounts on their oil. I mean, that was one of the goals of Western sanction policy.
Yeah, they have had big discounts, but now if you need a barrel of oil, India, which had been turning away Russian oil over the last few weeks from pressure from the United States, has now started turning back toward receiving Russian oil. It appears that Russia oil is going to be more available to consumers who need Russian oil, who have been pushed away from it.
And other non-Middle Eastern producers, Guyana, Canada, I guess, ultimately, and the USA, insofar as it's going to get more potential, or it is going to get more for its massive oil exports.
Yes, definitely. The producers that can get their oil to the market will be the beneficiaries of this move.
What about, will Washington, though, be anxious to see a rise in domestic gasoline prices in advance of the midterm elections?
Yeah, I think that's going to be a problem for the U.S. I think there are still some levers the U.S. can pull that can ease a little bit from the high prices that we're going to see if this war continues on and there continues to be a disruption. Some of the high prices can be eased either through a gasoline holiday that we haven't seen but has been proposed a few times. You could also release some of the SPR so that more product could be made available. The real problem with products is that you can't get the Middle Eastern product out of the strait. And so product is just going to remain constrained no matter how many barrels of crude you have. If you can't process it through the refining, then you're just going to have high product prices until we start to see relief as the Middle Eastern barrels can come to the market.
And you said a gasoline holiday, you mean a tax holiday on gasoline?
Yeah, sorry, the tax holiday, yes. It's been proposed a few times and it's never made it through Congress, but maybe this time it will make it through.
China could be a winner here. They tend to do this, don't they? When commodities are low, prices are low, they snap them up and put them in a stockpile. And they've been doing that with oil?
They've been doing that for the last few years. They probably, from crude oil, they have about 80 days of cover. If you add crude plus products, they have well over 120 days of demand cover. But China has a lot of opportunities to them. They have really high inventories, so they can meet their domestic demand, but they also can flex their policy. So their policy has been, in order for you to be able to export a product, you have to get an export waiver from the government or an export quota. And today they closed that quota system off. So now China won't be exporting their product and they'll be keeping it inside of their country. And then the third option that China has is they're still receiving Russian barrels. So while they have been a taker of Russian barrels over the last few years, they'll continue to receive Russian barrels unless Russian barrels will somehow get a waiver so that they can go to other countries other than China and India, which is where they mainly have been finding their homes.
Let's look at the people who are going to be hurt here if this keeps up. Europe imports vast amounts of oil and refined fuels. Jet fuel, diesel could be a particular vulnerability.
Yeah, I mean, Europe gets 40% of its jet fuel from the Gulf countries. That's it. That's going to be a real problem. They have about 60 days cover of jet fuel at the moment. If that continues on, we will see very high airline prices. I mean, obviously, airlines are going to be one of the bigger losers of this situation. But European jet inventories could run dry if this carries on for more than 3 months.
I suppose just broadly, we have seen run-ups in oil after violence broke out in the Middle East in the past. And then it's tended to subside. I mean, generally, producers, it's not in their interest, obviously, to see shipments cut off. Could this blow over fairly quickly?
You know, everyone keeps talking about what happened in June and what's happened before, where we have a spike up and then a crash down. In every one of those circumstances, production was not disrupted. Even during Russia-Ukraine, we did not have a disruption in oil production. So this is different. We actually have a disruption in production where we've had infrastructure hit, where we've had waterways closed. And if I had to compare this to a time in history, I would compare it more to the Arab Spring than I would compare it to June 25 or Russia-Ukraine.
Sorry, just remind us, when was the Arab Spring and what actually happened to oil back then?
The Arab Spring was in 2011. And during that time, and to be fair, during the Arab Spring, we did not have shale oil. So now that we have shale oil, because we have more of a fast response time to be able to get oil to the market, it's not going to be exactly like the Arab Spring. But during the Arab Spring, we lost Libyan production, we lost Algerian production, we lost some Angolan production. Basically, all of North Africa was had a lot of oil disruptions to the marketplace. And because of that, we had high prices for a sustained amount of time. And even to this day, I mean, it's been over 10 years and Libyan production still hasn't recovered from that.
That's interesting. And so, sorry, Michelle, before we let you go, was there a sustained rise in oil back then in 2011?
Yeah, we had high oil prices almost for the entire year, and oil prices were around, I want to say around $115 to $120 a barrel.
Thank you very much, Michelle. Really appreciate it. Michelle Brohard.
No, it's my pleasure.
Head of Policy and Geopolitical Risk at Kepler. Excuse me. Prime Minister Mark Carney signing new agreements with Australia. The two nations are going to work together to strengthen supply chains for critical minerals and flex their muscles as middle powers that are gigantic in commodities. We'll have more after this. Canada and Australia say they're going to work together on critical minerals. The Prime Minister, Mr. Carney, wants to strengthen ties with so-called middle power countries. He has said that global powers such as the US, well, you didn't name them, but he said global powers have resorted to new tactics of bullying smaller trading partners. Let's get more from Heather Exner-Pirro, Senior Fellow and Director of Energy, Natural Resources and Environment at the Macdonald-Laurier Institute. Heather, great to see you. So tell us about this new report. You were working with Australians here under the auspices of a thing called the Perth US-Asia Centre, and you came out with a report on the potential for Canada and Australia to work together.
Yeah, well, it's obviously an idea that makes intuitive sense. Both Australia and Canada are fairly small middle powers, but we both are resource superpowers. And so the idea is, are there ways that we could work together and coordinate to enhance our market power and even balancing power in certain commodities? And the idea behind that would be to kind of leverage our resources to constrain manipulation, pricing interventions, those kinds of things by the bigger guys or the bullies, as Carney referred to them. And just kind of resist that volatility or that interference in the market. It's
interesting. The report indicates some important commodities. When you combine Canada and Australia, we're number one in gold. Never knew that. Iron, I guess we knew that. Potash, lithium, even though Canada has virtually no lithium production, and canola. So Canada, I mean, these are, to use the cliche, resource superpowers when you put them together anyway.
Yeah, we did look at, a series, I would say the 2025 most important commodities by value, by geopolitics. And usually, one of us is a top 5 producer, maybe the other one is, somewhere close by. But when you combine our ranks, we're usually a number 2, number 3, number 1 producer in the ones you mentioned. And so the idea is, instead of, for example, in canola, where China can play Canada off or try to play Australia off each other, if we combined our power, market power, it would be much harder for China to play off us. In fact, we could be, the ones controlling the canola market and making sure there isn't redundancy for others. And then you start to wonder, what are other commodities in which coordination makes sense? And one different thing of Canada and Australia is, we have private sector players that are active in this. Most other countries do this with state-owned enterprises. And so we don't want to manipulate our free market. We want to leverage that expertise. So not to interfere with normal market functionings, but to constrain the ability of other people to interfere in normal market functionings.
I do like the last paragraph of this report quotes the Australian Strategic Policy Institute saying, we don't need more memorandums of understanding. We need an operational alliance. I mean, there's been so much talk about this, hasn't there, in recent years about asserting our security of supply and our market, our power as producers of these minerals. It seems like there's endless reports and alliances and politicians shaking hands.
Well, I have to say, as it just came back from PDAC, as many of your viewers would have, there were some significant announcements. There is some work being done. Obviously, the Americans also have their initiative with Project Vault. The G7 is finally taking this seriously. I do think we're at a moment in geopolitics where, obviously, Carney is being a bit more ambitious than Canada would normally have been. If we are going to do anything smart and strategic, this would be the time. And so just trying to create some buzz and some ideas of what that might look like concretely. What actual mechanisms would we be willing to use and could we use that would advance our interests?
Now, you say that, or the report says you're not envisaging Canada and Australia setting up a mini OPEC to restrict supplies of these minerals, but I don't know. We're not Boy Scouts either nation. I mean, we'd be quite happy to jack the price up if we could.
Well, and that's, that the intuition is, why don't we do an OPEC of critical minerals? Why is it always everyone else that is smart and savvy and uses their resources as leverage? Why don't we start doing that? And we would, but I have to say, Andy, I do think we are the good guys. And again, the case here would be to prevent that volatility. But in fact, when you're a reliable producer, it's actually good to be seen as the good guy. That is growing us markets. Yeah. It is making us more attractive to people. And so just to reassure those customers that we won't be the ones manipulating. In fact, if you go along with us, we're going to make sure that that market is stable, lacks volatility, and we're going to build redundancy of the system by making sure that we coordinate with each other.
Thank you very much, Heather. Always great talking to you. Heather Exner-Pirro, Senior Fellow and Director of Energy, Natural Resources and Environment at the Macdonald-Laurier Institute. Thanks. Let's have another look at oil, because we've had this incredible move this week on oil. Year to date, it's up almost 40%. Let's have a quick look at that 1 week chart again, because it is interesting. Oil went up, sure, after the Israelis and the Americans launched their attacks on the weekend on Iran. However, it wasn't a massive reaction, but we've just seen an accelerating move upward in the past 24 hours, because people are realizing the knock-on effects here with refineries forced to shut down. And there's probably going to be a global rush to buy oil now as people run out of their normal supply. Thanks very much for watching Commodities. We got the close next.